Do you see my screen?
Yeah, but
Okay.
can you please enlarge the screen a little bit?
Sure. Are you able to see now?
Yes.
Okay. So, sorry, we got disconnected. Actually, just for small sessions, we use the normal Zoom. Otherwise, we have a good version of Zoom integrated with our website, but that has a long procedure to enroll. So, yeah, I mean, just in interest of time, we are using this version. So, I think you were asking about CAPM, that is Capital Asset Pricing Model. So, before,
Yes.
I think your question,
Specifically the
yeah,
under and the over. Pardon?
yeah,
My
yeah, under and
apologies.
overpriced.
Specifically on the underpricing, I don't understand how you determine the overpricing and the underpricing of assets.
Okay. See, what happens actually, there are two ways to calculate the price of asset, I would say. One is CAPM. Okay, so wherein you take into account the market risk, that is beta. So that is one way you derive your returns, expected returns as per CAPM. And another way is you derive the price of the security based on the uh, expected cash flows. Say you are expecting dividends from the stock. So what you do, you try to estimate the price using using, like, you can say, cash flow model, like how the research analysts do that. 1 year down the line, price of this stock would be, say, X. So say you have CAPM and you have say analyst price, the research analyst price. They also have their calculation. They look at various aspects. So it gives you, say, return of 10%, and this
But
gives, yeah,
uh, please hold on. Is the analyst method the discounted cash flow method?
yeah, you can say dividend and other stuff isn't taken into account. That's correct. Yeah.
Okay, all right.
So based on the comparison of these two, the under and overvalued security is determined. Okay, so usually if these are two equal, the security is fairly priced. If I think CAPM is something which has a more value, I mean, I mean, I can confirm with you. So, like if it is 10%, so you can say, uh, I think I'll confirm back to you on this. I mean, I'm not able to recollect at this point in time, but I can confirm on this.
Okay, all right,
Yeah,
no
but
problem.
in nutshell, these two are compared, and or let me give me a moment. I'll confirm right away. Just give me a moment.
Okay.
So yeah, I think we were on correct line. So if your CAPM returns are more, like this blue line that you see in this graph is CAPM return, right? And this is something which analyst
Yes.
has predicted. So like your blue line, so when I say blue line in B, I'm comparing the Y coordinate, that is expected return. So blue line is higher than what analyst has predicted, like how we had in this case. So this security is overvalued. So one has a right to short, that can short the security because it is overvalued. Likewise, if CAPM returns are less and analyst returns are more, then the security is, are you with me? Can you guess?
Yeah, I'm still with you. I'm
Yeah,
listening.
yeah. So can you answer this?
So pardon, what we are saying is we have that SLM, which is the CAPM returns,
Yeah,
right? The returns that we calculated using CAPM. So the B and A, the points at B and A are the analyst
perfect. Yep,
calculations.
perfect. Yeah.
Okay. So we are saying if the price of the analyst, the return of the analyst which is A in this case, is above the security market line, which is the reflection of the CAPM.
Yeah,
So we are saying it's undervalued, right?
correct. Correct. That's correct.
So
Because, yeah,
what I don't understand is the reason why we are saying it's undervalued.
okay. So you want to understand the reason why we concluded based on the CAPM. Is that correct?
Yeah, why are we concluding that that is undervalued or overvalued?
A very good question. So see what happens that when you calculate the returns based on the CAPM, what you are actually doing is you are taking into account a beta, that is market risk. That is very like exactly replication of so there are implied things. So it's really a reflection of the market. Whereas on the other hand, what analyst is trying to calculate is just based on the forecast, which is something which is yet to happen, that has not happened. On the other hand, what you see on the SML, that is blue line, that is CAPM, it's like it has a real practical data that has gone into it. Like in this case, I'll explain you what is a beta. So beta actually factors into the actual data that is available on the stock, whereas analysis is something it's projecting that something will happen. That's why CAPM has a, I mean, thumb rule is more inclined towards the capital asset pricing model. Does that answer your question?
Yeah, can I ask about the beta in the market?
So you want to know what is a beta?
Yeah, what is this beta?
Yeah, what is a beta? That's what you wanted. Okay. So see what happens actually. Good
Yeah.
question. In fact, touch upon the fundamentals. Let me just track this down. Okay. So this is in fact about the beta. So over here, like if you notice, this is a data for Apple stock. This is a data for S&P. Apple stock is a part of S&P 500 index. So basically, if I were to tell you what beta is, it is the mathematical expression is this. But from understanding point of view, if you were to know that what is a beta, it is a change in your stock with respect to change in your index. So how your stock is changing, how your stock returns are changing with change in index returns. Does it make sense? Say any index that you can think of from South Africa.
Okay, S&P 500 is the index.
Okay, let's think about S&P 500. So what basically beta tells you is uh what would be change in your Apple stock returns if there is a 1% change in your index returns. That's the interpretation of beta in a very simple way, I can say. Does that make sense?
Okay. Meaning when we are talking about the market, actually, we are talking about the index.
Perfect. Yeah, that's correct. Absolutely.
Okay.
So
So
when
we
you
are saying, all right, how is the relationship between the stock that you are holding in relation to the market, which is the index?
that's correct. Absolutely. Yeah.
All right. Okay. No, now I understand what is this beta. That's why they are saying the beta of the market is always one.
Yeah, that's correct. Absolutely. Because I mean,
Why is it one?
yeah, yeah. In fact, indeed, it's the same reason that you just mentioned.
Oh, because every stock that operates in the market is being compared to the same thing, which is index.
Yeah, that's correct. Because see, if I say that, I mean, if your x and y variables are same, so if I calculate delta x by delta y, it would be same, right? Because eventually your both variables are, I mean, it's S&P 500 in numerator as well as in denominator. Whereas when I try to compare change in y with respect to change in x, so over here my returns are Apple stock. I mean, bit of mathematics, but yeah, over here your y coordinate is Apple stock returns and x coordinate is your S&P 500 returns. So That's why
Oh, all
you're,
right, I understand. So we are saying Apple stock over index,
that's
right?
correct.
Which is
Absolutely.
S&P 500.
Yeah,
Oh,
that's correct.
all right. That's the beta of A4 stock.
Yeah. In fact, another way is
Okay.
this formula. You can just it's like beta is a measure of stock volatility with respect to market. So when I say market, it's market index. In our example, is S&P 500. So like how your the covariance between your stock return versus your market return over market return. That's the one way. And so I have calculated. So what I've done, I have calculated the returns. So day over day returns for Apple stock and day over day return for S&P 500 index. And over here, like same formula that I shown you, I have applied that covariance between uh, stock index, stock returns, index return divide by variance of your index returns. That's one way. Another way is simple maths. As I said, delta y by delta x. So this is an array for your y variable. This is array for your x variable. Delta y over delta x is given by slope. And you notice this is same for both. If you go to Yahoo Finance also near this date, you will notice same beta. That's how the beta is calculated. Does it make sense?
Okay. Yeah, it makes sense.
And this is how you can plot, and perhaps you could have seen this graph multiple times in your quant book, quantitative analysis, that is paper 2 book in your level 1. uh, this is how your actual data may vary, and this is a best fit line, the blue, the best
Yes.
fit line wherein your error terms are very least error terms on this line.
Yes.
And few other phenomena you may, if you recollect very good, it's r square. I mean, if you recollect very good, any guesses what r square is?
Okay. I remember we had something like this in the line of best fit.
Yeah,
Then you measure residuals, right?
yeah, that's good.
Residual, which is the difference between the whatever a point of return to
Perfect,
the best line of best fit.
perfect. Yeah, that's correct. It's like
So we
predicted
square that.
versus, yeah.
Yeah.
But yeah, it's just a explanatory power. I mean, if that's a mathematical part that you were talking about, but if I were to explain very in a very layman language, r square is like how much better your changes in index is able to explain your stock returns. So if this is lesser, so 39% is quite lesser. So the high level conclusion is that you need, I mean, if I were to just do it more practically, you may have to include more variables which can explain your Apple stock movements better. Your S&P 500 index is not able to explain movements in Apple stock completely. It's just 39% of your returns are explained by index. You can include more variables like GDP, interest rate, or any other variable that you can think of. Does it make sense? Are you able to understand? Hello?
Hello?
Yeah, are you able to
Yes, I
follow?
think there was a
No problem. Yeah, but yeah, I mean, slight off the topic. I know you asked me for beta. I went in quant analysis, but yeah, eventually everything is interrelated.
from somewhere.
Sorry,
Okay. I love
I think you're breaking in between.
the
I can hear you now. Your voice is
okay.
breaking in between. Yeah, I can hear you now. Yeah,
All right. Yeah.
I think your voice is. I mean, you had some issue with your network.